Oil, natural gas, and coal prices have skyrocketed over the last couple of weeks worldwide, and this has led many Canadians to wonder, with winter coming, what the future of energy prices and also inflation holds for them. And that's what we're going to talk about today, is what this means from an inflationary perspective, what this means from a money perspective, and what you should be doing to prepare for higher energy costs coming in the next little while. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where one lucky subscriber is going to win $5,000 just for subscribing to this channel. So go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's discuss energy prices. We discussed the Evergrande crisis and what that potentially means for Canadians yesterday. Today, we're talking about the bigger and the greater issue in the worldwide economy, which is energy prices, which have spiked as much as 60% in the last couple of days. So let's have a quick conversation about that. By the way, before we get into it, at the end of this, I'm going to talk about what you need to do to prepare for potentially a recession in Canada and higher inflation and all of those things. Basically, what you need to do to prepare your mortgage and your finances in case something were to go wrong in your personal finances. And right now, I'm giving away my book, The Mortgage Millionaire, for free. It has a whole bunch of strategies that could help save you in the event that you found yourself in a financially difficult situation. All you have to do is go to mortgagemillionaire.ca, pay for the shipping and handling, and I'm sending that out. By the way, the first big round of these books went out this week. For those of you who are waiting for them at home, there is a special surprise in the envelopes that they came in. So when you get those, post on social media, let me know what you think of the special surprise in there. And for those of you who are getting the book in the next little while, you will absolutely get the same thing. I'm not going to ruin the surprise, but it's in there. So think about that as you're going and filling out your free book form and paying for that shipping and handling. So let's start first and foremost by talking about energy and what's happening in the energy economy. Basically, we have seen oil prices, we have seen gas prices, and we have seen coal prices skyrocket. Now, there's been some pullback on the gas prices. There's been some pullback on the coal prices. But basically, what started this whole thing is two things. First and foremost, OPEC not increasing supply as much as they were expected to, and also the Russians not providing as much liquid natural gas to the European economy as was expected. And both of these things have led to substantially higher energy prices pretty much across the board. Now, if we go ahead and we jump into the news and take a look at what's going on there, you can see first and foremost, the headline from the New York Times this week is energy prices spike as producers worry over the pandemic and climate. First and foremost, they're worried about the climate controls and the things that are going to move forward with respect to energy across the board. But they're also worried about what has happened during the pandemic and all sorts of supply chain issues that have come about as a result. And if you talk to or look at CNBC, I guess we don't get to talk to CNBC, we just get to look at what they're promoting and what they're publishing. Their analysts are saying that oil prices could hit an off-the-chart spike by the end of the year. And what they're saying is basically over $100. And the main reason for this is OPEC sticking to its oil pact and oil prices basically being in a position where they almost definitely have to climb. And Biden and the Americans are basically looking for foreign producers to produce more oil, because what they're finding is that they're in a situation where oil prices are going up so substantially that it is leading to higher costs for fuel and could eventually lead to higher costs for other things, like pretty much every product that is shipped via a gas transportation method in the US economy. Now, in the past, if you go, 1920s to 1970s, 1980s, oil prices, gas prices, and inflation were very much linked. If oil prices and gas prices went up, so too did inflation. Now, since about the 1980s, this hasn't necessarily held true. So an increase in oil prices and an increase in gas prices doesn't necessarily mean higher inflation, but it definitely does not help. Now, with everything that's going on with the transitory inflation that's expected and prices that are expected to filter back down, this could be a problem if we start to see the prices of energy go up, and then we start to see, as a result, other prices of goods and services go up, especially when we're having a low growth economy. Because here's the thing, right? What happens in a low growth economy, especially where there's inflation, and in theory, this is called stagflation, is you end up in a scenario where you have prices of goods going up. You have prices of things like oil and gas going up. Of course, oil and gas are a necessity. You have to heat your home. You have to put fuel in your car. And as a result, the money spent on those things doesn't get spent on other goods. And that eventually leads to the situation where you have less growth in the economy because less money is being spent on other things. And then you have these higher inflation numbers, you have low growth, and that's what leads to stagflation. This is what happened in the 70s when you saw interest rates go into the double digits. It's because Paul Volcker, the chairman of the Federal Reserve at the time, he decided to increase interest rates to get rid of inflationary pressures. And when he did that, it pretty much increased interest rates overnight to the high teens. And that eventually did eliminate the inflation problem. But what it did also was it created a jobs problem. And the lessons of the past, at least what we're seeing right now, is that they are not looking to merely wipe out inflation anymore. They're paying attention to the job scenario going forward. And if you go and you take a little bit further of a look into this, and if you go and you take a look at what is being said by Kathy Wood, who runs ARK Investments, she's saying that the next major issue is deflation. And she's saying this for a couple reasons. First and foremost, the reason she's saying this is because there's a high level of innovation happening in the economy right now. And that high level of innovation is eventually going to lead to less jobs and therefore deflationary pressure. And the second reason is because what she is seeing is that manufacturers and producers have increased their orders and tried to increase the amount of supply due to the supply chain issues that are happening all over the world. If you go and you take a look at the news right now, there are hundreds of container ships off the coast of the US that can't get to port because of the port backups. And what she is saying is that a lot of manufacturers have increased their orders of their goods that they use to manufacture their products. And as things start to get back to normal with supply chain issues, what we are going to find is that there's going to be a massive amount of products available, and that will lead to lower prices as manufacturers try to offload those goods for lower prices. So there's a lot going on here. And at the end of the day, here's the reality of this is nobody really knows what's going to happen. Could there be deflationary pressure? Yes. Could there be inflationary and stagflationary pressure? Yes. Are there going to be higher energy prices? It definitely seems like it based on today. So the question isn't necessarily what do I think is going to happen and then how do I go about making a play to protect myself from that or to take advantage of that and make more money. What needs to happen is that each individual Canadian needs to look at their personal financial situation and say, how do I set myself up to take advantage of things like higher prices and a booming economy in the future? But how do I also go ahead and make sure that I'm set up so that if something bad does happen in the economy or I lose my job or something unexpected happens in the real estate market, that I am prepared? And I am going to go ahead and make a huge suggestion here based on a recent article that came out from a survey done by Myers-Norris Penny. I'm going to pull it up right here. And this is, I think, the big problem in the Canadian economy right now. It isn't housing, it isn't inflation, it isn't stagflation. It's the fact that Canadians have gone back to their addiction to debt. And if you look at the numbers from the latest Myers-Norris Penny Consumer Debt Index, 58% of Canadians are likely to take on more consumer debt before the end of the year. And these same Canadians are also very, very, very worried about higher inflation rates. So the message here, and what do you do to make sure that you are in a good position financially, is to stop taking on debt. Just stop spending if you don't have the additional cash. And here's the big one. Here's what we see all the time with respect to people when they come in and get mortgages from our company. When they get their mortgages, they also almost always have two other huge debts. If they're a couple, if they're single, they have one other huge debt, and that is their car loans. And to me, this is the single biggest risk for Canadians when it comes to having a mortgage and being able to maintain their way through a recession or any sort of inflationary or deflationary or stagflationary pressure that comes up in the next couple of years, or through higher heating costs and so on and so forth. And that is to get rid of the freaking car loans. There's no reason for somebody to have to go out and have a $50,000, $60,000 purchase that is all done on credit in order to drive the latest, greatest vehicle. I can tell you unequivocally, I've been driving a vehicle without a car loan for quite a while right now. Yes, I have maintenance issues because because it's no longer on warranty, but it is a very nice truck. It's a very nice vehicle. And if something comes up that costs me $2,500 or $5,000, that's better than me having to pay $6,000 to $8,000 a year in the financing payments. And here's the other big thing. Let me show you what eliminating 2 car loans would do for an average family who's getting a $500,000 mortgage. So average car loan we see for somebody who's getting a $500,000 property is about $600 per person. They typically run about $1,200 worth of car payments alongside their mortgage, which is coincidentally probably around $1,600. Let me show you what eliminating those 2 car loans would do. It's really amazing with respect to the impact that it would have on a mortgage. So let's say you take those 2 car loans, you take that $1,200 and you put it aside. Preferably what I would like to see people do is put it aside and have it grow rather than put it directly onto their mortgage unless they have a readvanceable line of credit, which gives them the ability to access the extra money that they pay down on their mortgage. But let's just say you took that money and you applied it directly to your mortgage over the next 5 to 10 years. Well, what that means is that you would take your 25-year mortgage and you would reduce it from 25 years down to 13 years and 2 months. So basically what would end up happening is simply eliminating car loans would make it so you really only have 2 5-year terms with respect to owning your property. Now, people always go, Nolan, how the heck am I going to be able to pay off my mortgage in less than 25 years? The answer is really, really simple. Get off of your addiction to car loans. That's it. Get off of your addiction to other debts as well. But if you can just eliminate car loans, the things it does for you financially are absolutely huge. Don't get attached to that BMW, that Audi, that really expensive car. Simply drive something that's nice, that's reliable. You can buy a 5 or 6-year-old Audi or BMW for a fairly reasonable price in all cash. Your maintenance costs in the long run are probably going to be pretty minimal. Yeah, you might get stuck with a big bill for something, but for the most part, most people won't see a huge maintenance bill in the lifetime that they own a vehicle. And if they do, it's really easy to flip it into another used car. And this single idea, this single piece of advice, which is getting rid of those car loans, can have a huge, huge impact on your financial future. But better yet, think about what would happen if you took $1,200 a month for the next 12 months and you put that aside. You'd basically have $14,400. Think about how that would change your perspective with respect to if inflation was high, energy prices were high, if there was low growth, you lost your job, or something happened in the real estate market. It would be an absolute game changer. Now think about if you did that for 5, 10, 15 years, had a paid off mortgage, and you were completely debt free. So again, that's why I encourage you to go take a look at my book, The Mortgage Millionaire, completely free, just pay for shipping and handling. And if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. Don't forget about our race to 25,000 subscribers, and we'll see you on the very next one. Cheers.